Good morning. As we look at the boards, the U.S. markets are currently closed. Datavault AI Inc., ticker DVLT, finished yesterday's session on November 5th, 2025, at $1.60 per share. That was a sharp drop, closing down 18 cents, a loss of 10.11% for the day. Now, for a stock that has been on an absolutely blistering, face-melting run, a 10% drop is the kind of thing that shakes the branches. The common belief, the story everyone sees, is that Datavault AI has had a 720% rally in the past month. You see the press releases, AI-driven tokenization, Web 3.0 infrastructure, a potential $2.55 billion milestone deal. The expectation is that this is the ground floor of something enormous, perhaps the next NVIDIA stock in a very different field. But that $1.60 close and that 10% slide is the reality. And it's a reality that suggests the market is finally tapping the brakes and asking some very hard questions about what is actually under the hood. What many saw as a rocket ship is suddenly sputtering, and it's happening right after the company dropped its biggest news yet. This isn't just profit-taking, it's a cold dose of skepticism. The expectation of endless gains just met the reality of a fundamentals check. Let's retrace the tape, because the recent movement is where the whole story is. This stock was trading at just $0.25 in September. It was essentially an undiscovered or perhaps ignored microcap. Then October hit. The news started to flow. On October 13th, a letter of intent to acquire NYAAX. On October 22nd, a plan with Wellgistics Health. On October 24th, news about its Swiss exchange. The volume exploded. We're not talking small cap volume. On October 24th, it traded 197 million shares. It hit $4.10 on October 27th. This is the kind of parabolic move you see on the Robinhood app or SoFi Invest, where traders are piling in on momentum and headlines. This is not the slow, steady accumulation you'd see in Fidelity mutual funds or a Schwab Intelligent Portfolios account. This was a frenzy. But look what happened next. After peaking at $4.10, the stock has been in a free fall. It closed at $3.28, then $3.23, then $2.52, $2.03, $1.84, and now $1.60. It has been cut by more than 60% from its high in just over a week. That 10% drop yesterday was just the latest step down. So what's going on? The expectation was that the good news would keep the stock high. The reality is that the news itself, when you read the fine print, is perhaps what's spooking long-term holders. Let's look at the two big announcements this week. First, on November 3rd, the company announced a Dream Bowl draft and a meme coin distribution. Let's just pause there. A publicly traded NASDAQ company in the middle of a serious attempt to validate its high-tech AI platform is issuing a meme coin? This is a massive disconnect. You don't see Apple stock or Tesla stock issuing meme coins to promote their products. This kind of move screams speculation and hype, far louder than it screams stable business model. It feels like a move designed to capture the attention of the Robinhood stock trading community, not the institutions that use platforms like Interactive Brokers for deep fundamental analysis. Then, just one day later, on November 4th, the company drops what should have been its crowning achievement, a $10 million worldwide exclusive license agreement with Scilex Holding Company. The deal is for tokenizing real-world assets in biotech, genomics, and drug data, with potential milestone payments up to $2.55 billion. This is the entire bull thesis in a nutshell. This is the story. So why did the stock collapse? Because the expectation of a $2.55 billion deal runs into the reality of the terms. That $10 million license fee isn't cash in hand. It's paid in 4 equal installments, starting on December 31st, 2025, more than a year from now, and stretching into late 2026. That $2.55 billion isn't revenue. It's a distant, best-case scenario milestone payment that may never be triggered. The market, after a day to digest this, seems to have realized that this massive deal provides no immediate cash flow and doesn't solve the company's biggest problem. And that problem, the reality of the situation, is the financials. This is the part that gets lost in the hype. The expectation is a high-growth AI company. The reality, according to its most recent filings, is a company with trailing 12-month revenue of only $4.44 million. At its current market cap of roughly $450 million, that gives it a price-to-sales ratio of over 100. For context, that is an astronomical valuation. But the revenue isn't the scary part. The scary part is the losses. The company's net income for the same period is a loss of $68.61 million. Its net margin is a staggering negative 1,309%. That's not a typo. It is spending multiples of its revenue just to keep the lights on. Its cash flow from operations is negative $17.53 million. This company is a cash incinerator. This is the central tension for anyone looking at this stock, whether you're a self-investing pro or just getting investment help. The company is burning cash at an alarming rate, and its solution is to announce deals that might pay out in 2026 and to issue a meme coin. This is why the stock is falling. The 720% rally was the expectation. The 60% crash from the top is the reality. So, what does Datavault AI actually do? Setting aside the meme coins, the business model is ambitious, to say the least. It's a Web 3.0 infrastructure company. It's really 2 businesses. First, an acoustic science division, which has patented tech like ADIO, a data over sound platform. Think of an audible tones in a broadcast or a store that trigger a response on your phone. And second, and this is the one that everyone is focused on, is the data science division. This is the AI-driven tokenization platform. The idea is to take real-world assets, like the biotech data from Scilex, or the name, image, and likeness rights of a college athlete, or even political ad spend contracts, and turn them into tradable digital assets on a blockchain, or digital twins. They've announced plans to launch 4 independent exchanges for this: an International Elements Exchange, an International NIL Exchange, an Information Data Exchange, and an American Political Exchange. The idea is, frankly, incredible. The ability to value and trade data as an asset is a huge, untapped market. The company claims to be fully funded through a $150 million strategic investment from Scilex, which, by the way, was an investment in Bitcoin, adding another layer of asset volatility. The company's platform is built in partnership with IBM Watson X. It has over 70 patents. The bull case is that if just one of these exchanges works, if just one of these high-concept ideas finds a real-world market, this $1.60 stock price will look ridiculously cheap. This is the expectation that drove the stock to $4. But the reality is that they're trying to do everything at once. They're in biotech, sports, politics, audio marketing, and esports. This lack of focus is terrifying for a small company that is burning this much cash. A successful business usually finds one problem and solves it well. Datavault AI is trying to solve a dozen problems at the same time. This is where many investors get into trouble with online investing. They buy the story, the grand vision, without looking at the balance sheet. They see a low stock price on their SoFi or Robinhood account and think it's cheap, without realizing the market cap is already hundreds of millions of dollars for a company with almost no revenue. Speaking of that Scilex deal, I have to ask, comment below, do you think Datavault AI will ever see a single dollar of that $2.55 billion milestone payment? Looking forward, the path for this stock is entirely dependent on execution and funding. The bull case is simple. The Scilex deal, even with its long-dated payments, validates the technology. It gives them a flagship partner. The launch of the new exchanges, if they gain regulatory approval and find users, could create entirely new revenue streams. The patents could be licensed. The $150 million funding, if managed properly, gives them a runway. If they can survive, they might actually build something. The bear case is the one the market is pricing in right now. The company is burning cash too fast. The Scilex deal provides no short-term relief.